Welcome to the KP Podcast, where we talk about the business of real estate. A podcast about leveraging opportunities, growing your business, and experiencing financial freedom. Here are your hosts, Keith Anderson and Peter Cambucos.
All right, everybody, welcome to the KP Podcast. We're coming to you from the Forum here at the KB Studios. I'm Pete, sitting here with Keith, and today we're going to talk about something that happened last week where Keith and I were at. We were at the EXP Con in Las Vegas, and we're going to touch on our keynote speaker there today and kind of what he said. But Keith, why don't you fill everybody in on how it was last week?
Grant Cardone, keynote speaker of EXP Con. What was it, a week ago? About a week ago?
Last week.
And got some great stuff, first off. If anybody hasn't heard Grant Cardone speak, it is an adventure to say the least. Mm-hmm. It is different than I originally expected. Like, everybody sees it online and they hear the stuff and you're thinking, hey, he beats to his own drum is a good way to put it. But you don't really know how much he beats to his own drum until you actually hear him live in person, unexpected.
Well, and I would say for anybody out there that doesn't know who Grant Cardone is, obviously just Google the name and you'll get a bunch of stuff. But he was in just this past season of Undercover Billionaire.
Yep.
He's a billionaire real estate investor, has created, is a best-selling author, books on sales and real estate courses and all of this stuff. So billionaire entrepreneur personality might be the best way to describe it for those that don't know.
And again, beats to his own drum. It's a big drum. He beats it very loudly and everybody can see it. So let me give you a little example, a little bit of fun from the conference. So here we have on stage, it's the main presentation. After this, everybody's really going home. There's no more stuff after this. He's closing out the general session for EXPCon. And he's on stage with the CEO, or not the CEO, the owner of, the founder of EXP, Glenn Sanford. And those of you guys that know Glenn, again, you can look him up. These are two billionaires on stage having a fireside chat type discussion.
With very different personalities.
Very different. So if you want to say introvert, that is cutting it short for Glenn Sanford. He is furthest on that side of the totem pole, if you will. He is a very extreme introvert. He speaks on stage because he has to, not because he wants to. And then you got Grant Cardone, who's the absolute opposite when it comes to extroverted, and he is on the other end of the range, and he speaks on stage even when other people don't want him to. So there's a completely different situation here. Okay, so we got these two individuals. There could not be a stronger dividing line between the two of them, and the tension in the room in front of 5,000 people is extremely real.
Not in a bad way. I don't want to make it seem like that.
No,
they're friends and
they're
they
friends.
work. Yeah,
but I'm talking about you can feel two personalities being different in an extreme way, and so it was awesome hearing Grant and hear him talk. And so to give you a little snippet, we got to a certain point in the conversation where Glenn is asking a question and Grant cuts off Glenn and says, hey, Glenn. And Glenn has to stop where he's at. And Grant says, you want to know the difference between you and I? He stands up and he says, I got these. And he reaches in his pocket directly into the crotch region. And everyone in the crowd's freaking out. And we're thinking the worst, which we shouldn't, because all of a sudden Grant pulls out a handful of chips from that night gambling. So we were all relieved. We were like, oh, he was gambling. No big deal.
Thought it was going somewhere
Thought it was
else.
going bad. Glenn's turned white as a ghost. It was the worst thing I've ever seen. It was hilarious. And then Grant pulls out these chips. Glenn sees the blood rush back to his face as he realized it was just the chips. He slams these chips on the table and he says, right there. Grant's like, right there, that's the difference. And Glenn was like, oh, so you were gambling a little bit? And Grant says, no, take a look. He's got over $50,000 worth of chips sitting on the table. And Glenn says, oh, so you won a little bit. And he's like, yeah. And get this, guys. This is the best part of the whole thing. Some random guy in the middle of the crowd chants back, throw it out to the crowd. Just as loud as possible. Just yells it.
Throw the chips.
Throw the chips out to the crowd. Just completely, it's pitch quiet in there. And he yells this. Grant Cardone looks over at Glenn, looks down at his chips, grabs them, and just chucks them into the crowd. And if you've never seen agents trying to dive on the ground for a $25,000+ chip before, that's what just happened.
Yep.
And from that point on, that conversation was started.
Somebody got that $25,000 chip, right? They
Yes.
put him on camera.
They put him on
They went
camera.
and found him.
He's like reaching
Holding
his
it
hand up
up.
in the air, $25,000+ chips out in the crowd. Just, no big deal. Grant's just throwing them out there.
So that was good. That was a good time. And it was definitely a good time at EXPCon last week. So, and then what we want to talk about is Grant went on to talk in that keynote speech about the fact that he believes we're in a super cycle, a real estate super cycle. Actually, I believe his exact words are a super cycle of super cycles.
Wow.
Right? And so, like I said, not shy. And so he's up there telling people, hey, I think this appreciation is going to continue. I think we're in a massive super cycle. And I think you're going to see a lot more than what we've seen over the last 18 months.
And again, he's not shy about it. He goes against the grain. Now, while you have everybody else out there screaming, watch out for a crash, watch out, like the signs are here, things are bad, you got Grant Cardone coming publicly on stage, putting his money where his mouth is. He's not shying away, just saying, random thoughts. He's investing, he's buying things, he's starting different like venture capitalist type syndications and things, and he's using his money to put it where his mouth is.
Still currently buying hundreds of millions of dollars of real estate as we speak.
Absolutely crazy. And so we're looking at this thing, and so let's dive into this a little bit. Appreciation will continue. And he's not talking 6 months. Mm-hmm. He's talking for the next 5+ years. Like he's talking, it's going to continue.
Yep. Yeah. Like he said, I think at one point he said could be as much of a decade.
As a decade of an appreciation. Now that's
pretty far out because who knows what's going to happen, 3 years from now. But I mean, we've talked about it before. Do we think that appreciation is going to continue next year? Yes. At what level? I don't know. Here in the Phoenix market, we've talked about we could easily see double digits again. Probably not as much as this year, but easily double digits. Could happen for sure next year. And how long is that going to continue? I don't know. I personally like to take it 6 to 12 months at a time, have a little more vision on it. But hey, here's a dude who's made way more money than we have talking about this thing's going to keep going, guys, for a while. And when we talk about why, and we always say that, when people think, hey, this is going to crash or this is going to keep going, what do we say? Why? Well, why do you think that? There's got to be a reason. And Grant did take some time to go into that. And, he talked about, especially the first thing that he was touching on is the money printing and the money supply. What you'll hear out there if you look into it at all, called M2. M2 is the actual money supply, for not just the United States, but for the whole world. And to kind of give you guys an idea, globally, so not just the U.S. here, we've increased the money supply in the world $20 trillion over the last 18 months.
So wait, you're telling me, Pete, I can't just print money? Like that just can't happen?
Well, they can. They are. I mean, that's what these
not,
governments are doing. They are. Yeah.
And that's the difference.
So what happens though?
Inflation.
So what we're seeing is the inflation. And that's what, I think people need to tie some of these very basic concepts together. We're all seeing it. There's no one listening to this right now that has not seen prices on just about everything in their lives go up over the last 18 months. Now we've got people out there in the public and in the government and in the Fed tell, oh, don't worry about it. That's just temporary. Here's what I'm here to tell you. Those prices ain't never coming back down. I don't know, where does Keith go? Chipotle. When Chipotle raised their prices on their burritos, they ain't coming back down.
Well, and I don't go to Chipotle anymore because we have staff members that refuse to invite me to Chipotle. So little shout out to Destiny out there.
That's probably good for you, dude. Good for you.
No, but so I agree with you. And so I was thinking about this thing with the appreciation and inflation, and we're going to see those prices increase and maybe a false sense of appreciation away because it's just because of a lot of the outside factors of it happening, right? Well, has there ever been a time in our history, and you might not know this is kind of out of left field, have we ever appreciated for 20 straight years?
Appreciated in the real estate market?
Consistently, or not consistent, but like gone up over a 20-year period of consistent appreciation.
Yes.
No down years in that 20-year span.
Yeah, at different levels, right? But what we're talking about is negative years in there.
Yeah, so no negative years within a 20-year time frame of appreciation.
Yeah, and I don't have them in front of me, but I believe so. And so we've had, areas where we've had that continual growth for long periods of time when it's at a reasonable level. And so we look
at the
at
rate of inflation or a little bit above that.
Right. Not anywhere near these levels. And so I don't, I guess maybe I should back up and go, you should probably check that. Yeah. I believe we have, though. But they've been much smaller levels. You could have a year where you went up 1%, still up technically.
Yeah. So because what Grant Cardone's describing, if we go push another 10 years, we're talking about a 20-year window of gradual appreciation.
Not gradual.
In some capacity, we've appreciated every year for 20. Because when did we start going up in the low teen? Like market crash 06 to 08 area. When did we hit the absolute floor?
Well, we probably hit the bottom. I was going to say about 2010, 2011 here in the Phoenix market.
So now we're seeing, since then, it's been a gradual climb since 2011. And we're talking, it's 2021. So there's 10 years right there. And if Grant goes another 10, if that prediction is correct, we're talking about a 20-year paced growth. And so I know a lot of historians and a lot of people, economists, they look at it as every 10 years you see a market try and make an adjustment of some sort of capacity in some sort of way. Well, is our adjustment here year 10 an increase extreme? Is that the adjustment that we saw was just we're way too low, we need to climb?
Maybe.
That's an adjustment, right? Like we see a drastic change after 10 years.
But there's a reason, because part of the reason like we're talking about is we're no longer in the normal market, right? Mm-hmm. When you've got the inflation and the money printing going on, and we've talked about this several times now, which is people look at the appreciation rate and go, oh, Phoenix is up 32%. And one of the first questions I ask is what percentage of that's inflation? Half of it? I mean, who knows? So the point is, when you're looking at that, it's not real appreciation. All of it is not real appreciation. So you've got the combination of, the low inventory that we're still working through, plus the inflation rates that we haven't seen. We're at the highest inflation rates now that we've seen in the last 15, 20 years. And if those sustain, we're going to hit, new levels that we haven't seen since the 70s if it keeps going. And that's to be determined. But if you listen to somebody like Grant who says, yeah, that's going to keep going because they're not going to stop with the money printing. We're not going to stop with the inflation. Well, then we're probably going to continue to see that appreciation continue. That's the part that needs to be determined is, will we continue to see that inflation rate? That's what it hinges on. Because what happens, and this is key for everybody to understand about why we're seeing this with real estate, why Grant's talking about this, and why you see a lot of money coming into it. If they are continuing to print money, if we're continuing to see this inflation rate, it means your money is worth less, your currency, right? If you've got, the same house and now there's more dollars chasing that same house, well, it's just going to take more dollars to buy that house, hence inflation. And so what do you want in an environment like that? You want real assets. You want things that we've talked about before, real estate. That's why cars are going up, gold. People will throw Bitcoin or cryptocurrencies into that, if you will. You're seeing it with art and other collectibles. Real assets. So
in the 21st or in the new age, fake currencies or false, like non-tangible items is considered a real asset.
Hey, our currency,
something you can't touch.
Our U.S. dollars are fake currency. There's nothing backing them besides the faith of the U.S. government.
You
right?
can touch that, and that's not even real.
So, that's nothing there.
So it's great that we're pointing this out. And so the thought is, we have low inventory, right? And you want to own assets where there's limited capacity of those, low supply of them. Because if you own something that everybody else wants, and there's very limited of them, and you own a lot of them, well, great. That's a great investment at that point, and it's going to retain value through inflation, through those tough markets. And so with that supply, I guess my question is, when you see these more and more houses are getting pulled off the market, right?
Yep.
These
for
funds,
longer periods of time.
These funds are buying and holding properties, and we've talked about it outside podcasts, is they're doing it for tax reasons. They're doing it for a lot of other things, right? You need to find all of these different directions of being able to move their money and hold their money in places and leverage them. How are we going to see this supply come back over the course, and how long? How long are we going to see this? Like in reality,
it's gonna. I mean,
correct. Is 10 years logical?
Yeah, I don't know. I mean, market by market. I mean, here in Phoenix, we've talked about it. We still got some time. We still got another couple of years to catch up with that inventory, unless something drastic changes. And that's why I say we like to look 6 to 12 months out, because who knows if everything continues kind of in a similar fashion as we're seeing now, could be another 2-3 years before that inventory evens out. Who knows? But yeah, you're right, because kind of part of what's making that tougher or slower recovery on the inventory is twofold there. Not only are we seeing these big hedge funds and big companies coming in, buying these assets. And like you said, why are they buying them? Because they're looking at the same thing. They see their money being devalued. They want real assets, which are going up. Hard assets are going up because as money continues to be printed and we have inflation and your money is continue to be devalued or worth less, you want to buy real assets with that so you can hang on to your purchasing power, hang on to your wealth right there. So they're buying these homes. And like I said, they're taking them out of inventory for long periods of time. These are people that their plans, if you listen to them, they're planning to hold these for the next 7 to 10 years. We're also seeing the other phenomenon that we've talked about, which is people staying in their homes longer. When I first started in the industry, the average was about 5 years or so. Now we're seeing people on average staying in their homes 7, 8, 9 years. That's not what it used to be. So you've got people staying in their homes longer. You've got inventory being taken off the market for long periods of time by other companies and hedge funds, which are turning these into long-term rentals, which is taking even longer for the other inventory then to catch up to a normal market.
So with that, like one of the questions that comes to mind is, as we see inflation increase, as we start to see this thing continue to roll the way that it's going, and prices eventually continue to climb, because at this point, if we still maintain low supply and we still have this strong a demand, prices are going to continue to climb with inflation. Like, it's just a given. That's just a normal supply and demand model. So back ending to this concept is, do we see the rental market continue to move? Because if all these investors are holding down these properties, and we are in that super cycle, at what point do you think the demand starts to pull off because they can't afford these houses anymore? Affordability changes.
Yep.
Then does that force more and more people into the rental market, which inadvertently hurts supply even further because now the investors are making higher returns, and so they're keeping their houses even longer?
Which drives rents up and, could push it on that side too.
It's like,
and I think the thing to keep in mind, and a lot of times people don't want to get too much into politics. It's not politics per se, but it's just the way of our government, regardless of who's in power, works. And what you want to keep an eye on is, are they going to continue to do things the way that they're doing things now, which is the same way that the previous administration did it. So we had it done before. They're continuing it now. I would say accelerating it now, which is, are we going to continue to run these huge deficits, continue to print money, continue to have low rates? As long as we continue to see those things, we're going to continue to see a lot of the same circumstances. Now, one thing I noticed last week is kind of going back to what you just said. Hey, when do we run into an affordability issue? If we keep going, when can people not afford them? And you have some people out there who claim, hey, we're going to run into that and inflation is going to stop because people can't afford it. Well, you had the president come out last week and make a speech talking about how he not only wants to increase the minimum wage, but he wants to bring these high-paying jobs, these union jobs to the U.S., or help the people that are here now get these higher-paying union jobs. And, he's in his speech talking about not $20 job an hour, $25 an hour, but $45 an hour jobs for union workers. If we see the increases in wages on that side, I think all bets are off at that point, because now you're going to have inflation where then I will agree with Grant Cardone. We haven't seen anything yet. If we get wage inflation, then at that point, these prices are going to the rents, the prices, the inflation is going to go even that much higher, because that's been the one thing that certain people can point to and go, we're going to run into this affordability issue. The wages aren't going to keep up. If we see that wage inflation, all bets are off.
Well, and that's the thing that's crazy about it is that's the definition of inflation. If both sides of this thing go up, then that means our dollar just becomes less and less valuable at that point, because we need more of them. If they're making more, things cost more. That's when you start to see. But
there's not more stuff, right?
There's not more stuff.
That's the problem.
In essence, is that not where you start to get to the normal local guy, Joe Smith, wheeling barreling his wad of cash to buy a loaf of bread? Like, is that not where you start to get to that? Yeah. We're already seeing it with gas prices and things like that. We're already seeing a little taste of it again. That was just the other day. I saw gas over $4 here in Arizona. Granted, it was a Chevron, and it's way more expensive than everything else. Chevron and Shell. But we're seeing things that we haven't seen in years.
So
10 years ago.
I agree. And so what do we do here? What do people do? I think I agree with Grant, and this is what we're doing, and it's what you're looking at. As long as this stuff continues, then what you want to have is real assets.
Go with the flow.
Especially with good debt. And what I mean by good debt, covered debt.
Yep.
Stuff where, if you're buying investment properties and now you're mortgaging that, well, you're leveraging. Each year, the money you owe is being, worth less and less because they're inflating it away. And you've got tenants in there that are paying your debt for you, covering the debt.
What do you have to lose?
Yeah, that's how these folks are making their money. Your assets going up, your debt's being paid off for you. Each year, your rent's probably you're getting is coming in more, and the money you're paying back stays the same and is continued to be worth less. Now, if, like you said, this stuff continues, that's the way to do it. That's what we're doing. That's what you see Grant doing. He says that's going to accelerate and continue. I would say at least for the time being, he's probably right. What you want to watch out for is, do we wake up one day and realize that our government all of a sudden decides to rein things in? Do we ever foresee something where they get up and go, man, our spending's out of control. We're printing too much money, guys. Rates are too low. We got to rein all this in. Now, if we wake up one day and see that,
you're asking the government to be logical.
Yeah, I don't think we're going to see it.
Logical?
But, we got to tell you, like, what are we looking for? If you guys start hearing stuff like that,
let us know. Please call into the show, questions at kpeliteaz.com.
Absolutely.
If you hear that anywhere, I need that article.
And I'll tell you what, I'll be one of the first people that you go, now we can discuss a real estate crash if we see that. The chances of hearing anything like that anytime soon are
printing.
Slim
They're
to
still
none.
Pushing.
Yeah.
If the government has that much debt, do they want that? Inflation, debt is good in an inflated market if it's covered, if it's strong, and if it's cash flowing. Like that's just plain and simple. So at the end of the day, don't trust the stock market. Start moving towards those hard assets. Follow the flow of what our economy is giving you. If it's giving these things to you on a silver platter, take the silver platter and invest it and move it.
Because, don't make it harder than it needs to be.
Don't reinvent the wheel. Look at what all these people like Grant Cardone are doing. He is a billionaire in the real estate industry, and he is double downing on all the things that he's saying. He's putting his money where his mouth is. He makes a lot more money than we do. I'm probably going to follow somebody like that. That's that confident, that sees things that we can't see at a much higher, bigger, worldwide scale. That being said, we got to start to consider the different views when it comes to the market conditions and not just what the media is pushing as chaos.
And the last thing I'll say with that, which I think we've said in, probably the last 3 or 4 podcasts, is, guys, there is no such thing as a quote unquote real estate market. Real estate is local. Like we said, what happens in, Iowa has nothing to do with what's happening in Phoenix. These are different markets. And the reason we say that is there are markets in this country that are in bubbles right now. Absolutely, there are markets that are in bubbles. There are also markets still after this last year and a half that are cheap. And so there are, be careful what markets you're looking at. Be careful and do your own research because you've got both. So as long as you are doing your research there, still buying in good markets, not following some of these bubble markets. And when we say that, because a lot of people, well, how do you know? You're looking at, where's the population going? Where are the jobs going? Where are the investors and landlords being treated well? Where are conditions good? Where are the people and the industries going to? Those are the places where a lot of times you're going to continue to see that growth. Not markets where you necessarily see some of that stuff leaving or markets that didn't have much of that and they've participated in this big appreciation. Those might be some of your bubbles. So without, sitting here and giving specific advice on market by market, take a look at some of that stuff. I think you guys will be able to figure it out pretty easily.
Absolutely. Okay, guys. And like always, subscribe to our podcast. We're going to continue to bring you guys out relevant content on the market, where we're heading, and the entire business of real estate. Follow us on YouTube at The KP Elite, Facebook, Instagram, everything that we're going to continue to push out. If you'd like to be interviewed on the podcast, we'd love to hear from you. We'd love to hear your perspective and things like that. Reach out to us. We'll set that up. And like always, questions at kpeliteaz.com. We'd love to hear from you guys. And we'll see you guys next time.
See you guys.